Welcome everyone joining us today for the webinar Investing 102, Building Financial Security in an Uncertain World. It's a pleasure to have you all with us today. Before we begin, please note that the content of this presentation is for general information purposes only. It should not be considered specific personal investment or risk advice. While we strive for accuracy, the University of Queensland and our speakers cannot accept responsibility for any errors or omissions, and we strongly recommend that you seek personalized advice from a specialist investment professional tailored to your individual investment needs and circumstances. I'd like to acknowledge the land on which we meet today. The University of Queensland recognizes the traditional owners and their stewardship of these lands. We extend our respects to their ancestors and their descendants who maintain their cultural and spiritual connections to country. Their contributions are invaluable and we honor them. My name is Janita Jung, and I am the lead of the Young Professionals portfolio on the UQ Young Alumni Advisory Board, as well as the Group Marketing and Technology Manager at Risk2 Solution Group. The UQ Young Alumni Advisory Board is dedicated to fostering a vibrant community of young graduates. Our mission is to provide meaningful opportunities for young professionals to connect, engage, and grow both personally and professionally. It is with great pleasure that I introduce our key speaker for today's webinar, Tom Cochran. Tom is an outstanding figure in the financial services sector, currently making waves as the National Account Manager at Morningstar. With a strong educational foundation, Tom majored in economics, where he developed a keen interest in the behavioral aspects of the discipline, an interest that has clearly influenced his approach to financial advice and client relations. Tom's career started in the financial advice realm, working alongside his stepfather and then moving to Morningstar. In his current role, Tom collaborates with major financial service licensees across Australia, focusing on enhancing the quality of financial advice delivered to numerous Australians. We are indeed fortunate to have Tom here today to share his insights and strategies with us. Please join me in warmly welcoming Tom Cochran to our webinar. During this webinar, we encourage you to submit your questions through the Q&A feature on Zoom, and we'll address your questions at the end of Tom's presentation. So without any further ado, let's dive into the insights that Tom has to offer, and please join me in welcoming Tom to come online. Thanks, Tom.
Thanks, Janita. I'll just share my screen now. So I was given the brief for this webinar to term it Investing 102, and the theme that we came up with was building financial security in an uncertain world, which is really quite pertinent in the cost of living that we're facing at the moment and a lot of economic uncertainty. So that's the brief that we were given, and I'm really looking forward to presenting to you all along that topic. Before I do, I just have to pause on this slide for a moment, just some of the legal stuff. Okay, cool. And before I tell you more about who I am and what I'm going to talk about, I just wanted to brief everyone on who Morningstar is. You know, some of you may have heard Morningstar through the data that we might present, whether it be through editorial or our journalism outlets. But Morningstar is a global financial institution. So we're present in 32 countries. And as you can see there, we cover over 600,000 investments. I joined Morningstar because I was quite passionate about the mission, which is to empower investor success, which I think is really important to me personally, and I think to a lot of Australians as well through the products and services that Morningstar offers. And I think one thing that really appealed to me with the company is that the research is independent. And why that's important is that Morningstar doesn't take fees for ratings, and that filters through everything that they do from a research perspective. And there's a lot of behavioral science, and my colleagues over in the States in the behavioral finance team are really doing a lot of work to improve the well-being for a lot of Australians. So what are we going to talk about today? I've broken the presentation up into sort of two themes, I suppose. The first one is what we term back to basics, and that's building the foundation. So I'm going to go through some topics which maybe quite a few of you have heard about. We're going to talk about just some basic budgeting. We're going to talk about cash flow. And then really the key theme for the back end of the presentation is going to be leveraging the power of goals-based financial planning. So my background, as Janita said, was working in financial advice. My stepdad, he is a financial advisor, and I was quite fortunate to work with him in the family business during the startup phase. And that was really my foot in the door into the financial advice industry. And I truly saw firsthand the power of financial advice for everyday Australians. And now my role in Morningstar, where I work with hundreds of financial advisors and Australian financial services licensees, both directly and indirectly through my work, I see the power of financial advice. And that's where I'll be sharing some of the secrets and how you can really use those techniques that financial advisors charge thousands of dollars for. Now, before I go into the topic, I just wanted to give you all an overview of where you can get help. Not only myself, but Morningstar as a company does firmly believe in the power of financial advice. Unfortunately, due to the nature of the industry, with quite a significant amount of advisors leaving the industry, a lot of advisors now focusing their attention on high net wealth individuals, it means that the average cost of advice is approaching, as you can see there, nearly $3,500. And that's quite a lot of money, especially for young people. And it's really those people that need advice the most. And so not only will I'm hoping that what I'll talk about today will supplant some of the services that a financial advisor might offer, but there are other avenues that you can seek help. So before we get into it, the first one that I wanted to highlight is moneysmart.gov.au. It truly is one of the most fantastic free financial resources out there. So this is run by the Commonwealth Government. It contains tools, calculators, database and registers from everything ranging from mortgages to investments to cash flow and budgets. And I'll even be highlighting one of the tools that I would suggest that all the viewers use later in the presentation. But importantly there, I've noted that it does contain a directory to some not-for-profit organisations, and they provide some emergency counselling. So if unfortunately you're in that position, I would highly recommend that you visit MoneySmart to tap into that resource. The second one is your super fund, and it's really quite pertinent for every Australian that's working. You'll have the superannuation guarantee, and that means you'll have your funds invested within a super fund. A lot of those super funds do offer some form of financial advice, and a lot of them do offer it for free. Now, the nature of this advice is limited in scope. Typically, the funds only offer advice relating to your holdings within the fund. But it's really important, if you are wanting to go on this journey of improving your financial well-being, super really plays a key role over the course of your working life and retirement. And the decisions that you make now, particularly within the super fund, will really impact where you are in 20, 30 or 40 years' time at retirement. So it's really important, if you are within a super fund, seek out that advice if it is free of charge. I wanted to give everyone an overview of who are investors. There seems to be this perception that, investors are, probably older, probably just a bunch of blokes. But in reality, what the data shows is that investors are becoming younger and they're becoming a lot more diverse. So you can see in the slide here, the average age of investors has decreased from 46 to 34 for those intending to invest. And those that invest in the last 12 months, 45% are women. So it really does highlight the changing nature of people that are investing. And that's a really great thing, because the earlier that you invest, the better your outcome will be. And that's a pretty neat segue, I think. Before we get into some of the basics, I wanted to signpost the start of my presentation by really highlighting starting early and starting with investing. When Nina and Janita sat me down, they said the focus was on the younger alumni network, which I think is fantastic, because I think those are the people that should really start now. So what I did was, with some of the tools that I'm fortunate enough to have access to that we provide to our advisors, I did some modeling, and I looked at a scenario. If I was a 25-year-old recent graduate, I'm quite fortunate enough to be earning a great salary of 85,000 per annum. What would that look like if I started investing? So I did the numbers. After tax, it's about $1,200 per week. And what would that mean if I was able to commit 10% of my net salary after tax from now at 25 all the way until 65? So about 40 years. So I made a few assumptions with this modeling. You have a year's savings already. The values that I'll show you are in present day, so they account for inflation. No changes to your income over time. A consistent investment return of 7% year on year, no investment costs, and no interest otherwise earned on your cash. And the scenarios run until 2064, i.e., when this person would turn 65. So obviously not very realistic, and we'll touch on that later. But for the sake of modeling, I wanted to demonstrate what this meant for starting early. So the first scenario was you save, but you don't invest. So from the age of 25, you save that $120 every week until you're 65. At that point in time, you will have just over $255,000. Now, let's say that you leave it a bit later, life gets in the way. Maybe you're someone like me, you chop and change your degree. Maybe you change your career, and that's perfectly fine. But you start at 35, but rather than saving, you're investing. So you're putting that $120 a week into an investment which is returning 7% year on year. So even though that you're starting 10 years later than the first scenario, and you only have 30 years to compound those returns, the power of investing more than doubles in that time. So you would have 637,000. Scenario 3, which I think is really powerful. Let's say you've got it together. You've watched this webinar. You've listened to what I said. You're writing it down, and you start from when you're 25. By the time you're 65, you will have over $1.3 million. And to me, doing this modeling really highlights the power of not just starting early, because you can start early and save, and you can see the difference here versus investing. But also not just saving, but also investing as well. So it plays a major role in your outcomes over the long term. So that leads me into my first topic. So I wanted to go over some basics, and I said here, buy a UQ grad avo on toast, you'll feed them for a day, teach a UQ grad to cook. And that's a play on the phrase, teach a man to fish. And I use that phrase because often as young people, I'm sure we've all heard, maybe from your parents, maybe from politicians, just stop buying avo on toast, stop buying that daily takeaway coffee, and if you do that, you'll be able to save up for a house. Now, obviously, that's a bit unrealistic. Putting away an extra $20 a week will amount you with a house deposit in a few years' time. But there is some merit to that in the absence of having a financial goal, a plan to achieve this, and holding yourself accountable. It becomes really difficult. And what Morningstar has consistently seen with the research over and over, that by simply having a plan, you will almost automatically be better off. And the reason for that is that you have something that you're working towards. And that sounds pretty obvious, but it's quite surprising how, in the absence of those things, how hard it is to stay on track. And that really feeds into that theme of uncertainty within the world today. So that's ultimately what we're going to work towards. But some of the basics to get us there. I'm taking a very investing focus perspective with this webinar tonight, but ultimately this applies for anything. It can be investing for your retirement. It can be saving for a house deposit over the next 2 to 3 years. But to reiterate on what I said, ultimately without the right foundations, it may mean if you're investing, you sell down at an inopportune time and you suffer losses. You might not be putting your money towards the best assets that might be achieving your goals, or you may not require what you need to reach your goal, and that just means taking on more risks than what you have to. So before we go on this journey of investing, some of the basics. So what are they? There's good debt and there's bad debt. And that's pretty simple. I've got some emojis there. Good debt is mortgage. It's your help loan. And then bad debt is things such as your credit card and your car. And so how do you distinguish between those two? Well, good debt is something that goes towards, it's productive. It'll give you a return on your money. So whereas a credit card, you might spend it on, wardrobe, or you might go traveling, or your car for that matter. Good debt, you can put it towards your house, which as you pay it off over time, you won't have those mortgage expenses in retirement. So you'll have those better outcomes. You can use debt to put towards investing, and that'll give you a return on your capital. It's going towards some sort of productive asset or outcome, whereas bad debt tends to be consumption in nature. And the thing with bad debt as well, it tends to be very high interest rate. So some credit cards, they get as high as 20%. Car loans as well are significantly higher. They're upwards of 10%, whereas a mortgage is 5% or so. So it's really important that if you have debt, that should really be, bad debt, that should really be the focus in the short term to pay that down. Because when you have debt that is both spent on something unproductive, such as consumption, and it's high interest, the opportunity cost to you is incredibly high, because often those interest rates that you're paying are much higher than any returns that you could get in the stock market, or any growth that your house's value might have over time. The next slide here, a lot of you would have heard, it's an emergency fund. And I think this is really important for some of those younger graduates that have just exited uni. Maybe you finished uni, you've got a job, but you're also moving out of home for the first time. You're going to experience a whole host of new expenses which you otherwise wouldn't have experienced. So it's really important that if anything does happen, you have what's called the emergency fund. Often we've seen advice, a lot of people out there say 3 to 6 months of your salary. Really what it's meant to cover is your living expenses. So it's important to plot out things such as your rent or your mortgage, food and groceries, power and gas, internet, if that's necessary, and anything else. If you've got a dog, obviously you have to account for the dog. And it should be enough to sustain you for that 3 to 6 month period. Obviously 6 months is, more on the conservative side, but it's to make sure that you have that fallback. And then as well, keep it out of sight, out of mind. By having that money, whether it be in a separate account or even in a separate bank, it removes that temptation to dip into that lump sum for maybe something that isn't an emergency, such as a holiday. And that's especially so if you are a recent graduate, where this is probably the first time in your life where you've had quite a significant amount of money. And if the first thing that you're prioritizing is working towards that emergency fund, it can be quite hard not to spend that money if you've been studying for 3 to 4 years, you haven't had any money, and suddenly you're on that salary of $85,000 a year. And obviously budgeting. So this cash flow statement here is one of the tools that I refer to on Money Smart. I think it's a fantastic tool. Going back to my remark about the Avo on toast, I think with budgeting, the most difficult thing is, like I said, not having something to work towards. What really you should be aiming for with budgeting is just to give you that transparency. It's to show you with a point in time snapshot of what's coming in and what's going out. It's really important to build that habit just to be mindful of how you're spending rather than being quite punishing on yourself to look at it and say, I've spent too much money on avo and toast, I've spent too much money on coffee, takeaway coffee this month. But just use it to reflect on your spending and be mindful of that, seeing it go in and out. And it over time, as you form these goals that we're going to talk about later, it'll really help you attribute your spending towards those goals. And it makes those decisions around your budget a lot easier. If you do, for example, need to cut back the avo on toast, or maybe it's rather than going out, cooking yourself a nice meal at home. So I'd highly encourage you all tonight at some point to go into Money Smart and use this cash flow statement tool. So that was an overview of the basics. We're going to go into some of the goals-based planning, but I wanted to give you all a crash course on investing, given that there is a lot of interest there. And like I said, financial advice is out of reach for a lot of people. So it's really important that you educate yourself and know what you're talking about, and you need to be able to speak the language. So for those that have never invested, there's a few ways that you can do it. Directly in assets like shares, so that might be a company, or it could be bonds, which is debt. So you can invest in government debt, private debt. You can invest in a managed fund or an exchange traded fund, or a combination of all of those. And that's typically what you would hear referred to as diversification. And so they all come with trade-offs, and it's beyond the scope of today's webinar to really drill down into those. But as you go away and think about the plan and how you're going to work towards those goals, some of the trade-offs you need to assess are investment costs, the risk versus returns, especially if your goal is more in the short term, investment horizon, so that's the timeline that you're investing for, any personal preferences as well, so if you have environmental or social concerns. And then separate from that as well, which I haven't listed there, is really the opportunity costs. And by that I mean you can spend a lot of time researching investments, and I do that as a hobby. I really like it. I invest in companies directly, but I work at Morningstar. I love the research. I look at, read the annual reports, but a lot of people don't, and there are thousands of professionals out there that do this every day. I think one thing you need to really consider is, do you go into something like a managed fund or an ETF, and it's sacrificing the perfect for a good night's sleep, because it really does take a lot of time if you go down that route to build your own portfolio. So now that we've covered that off, I just wanted to talk about how you can understand investments. I would highly encourage everyone to take what I'm saying and go away and the great thing about Australia is everyone is an investor. We all have access to a super fund. So even those that tonight say they aren't already investing, I would highly encourage you to rethink that, because every Australian is an investor through superannuation. And as you start to learn how to build your investment portfolio and review investments, there's two key documents that all products will have. And the first is a product disclosure statement. The second is a target market determination. And then most funds will have a fund profile, and companies obviously have annual reports. So what's a PDS? The PDS is a document that contains important information about a financial product that an investor must consider. And I'll note that both a PDS and a TMD are required by law. So the PDS will contain information about the key features, the fees, the risks, and the benefits. So I've used one of Morningstar's portfolios as an example to highlight that. So you can see there within the PDS, it outlines the management fees and costs. It'll outline things such as asset allocation, the kind of markets that the fund will be investing into. And then the TMD is a document which describes who a product is appropriate for and any conditions how the product can be distributed. And this is really important to know if you are the right person to be investing in this product. So I've highlighted here the Morningstar High Growth Managed Fund. And this is just a snapshot from the TMD that we supply. So anyone that is, for example, wanting to preserve their capital is not considered in the target market, and they should not invest within this product. So what does capital preservation mean? That means if you're someone that can't risk losing their money. For example, you're close to retirement, maybe you're saving for that housing deposit, and if you lose any money, that's a housing deposit gone. And then this is a fund profile. Think of it as like a one-pager. It will collate information from the PDS. It'll collate information from the TMD. It'll also have information on there which won't be present on either. It might be a bit of marketing, but it's quite interesting if you're wanting to understand the fund's philosophy. It'll have some great charts on there. So you can see, once again, this is the Morningstar one. It contains the fees here from the PDS, and then it talks about the investment strategy and the investment objective. So now that we've covered that off, you're wanting to review the PDS and the TMD. I'd highly encourage you to go to your super fund and start reviewing the products that you're invested in there. What are you then looking at for the fund? Well, the first thing is an asset allocation. So every fund is going to have, or generally every fund will have an asset allocation. And an asset allocation is the composition of growth and defensive assets. So a growth asset is one that has a high return but a high risk, and that would be something like shares. And defensive assets have low returns, but they have low risk. So that would be something such as just holding cash. And it will also have a percentage of the actual asset classes. So this is where the fund will outline how they've diversified the investments that they've made within the fund. So you can see here Morningstar's has allocated just over 65% to international shares, and you can see the breakdown here. When you go into the fund profile in the PDS, you'll see the investment objective. Think of this as the KPI for the fund manager, and if they can exceed this, they can charge a performance fee. This is incredibly important to know because it is a great metric to judge funds if you're looking at investing. And the lower that the objective is, the lower the bar that the fund manager has set for themselves. And if they exceed that bar, you will incur a cost, and potentially that'll reduce your returns over the long term. So for example, a lot of objectives set it by inflation. Some will set it by benchmark. So they'll set their objectives according to other investments. And if an objective is simply to exceed inflation by 1%, that bar is a lot lower than exceeding inflation by at least 4.5%, which in the Morningstar example I've been using, that's the objective that we use for that fund. You need to consider the fees. Now that's quite obvious. I've spoken about the fees that the fund manager will charge. So there's generally a flat fee that they'll charge. There might be a performance fee if they exceed their objective. But another thing that you should consider is the fees that are charged at what I call a platform level. So, for example, a platform fee for a super fund might be an administration fee, and that's charged irrespective of what fund you're in, or a brokerage. And a brokerage might charge you a monthly subscription. They might charge you a fee for every trade that you make. And so those fees will add up and they can have a significant impact on your returns over the long term. The next thing that all new investors should be considering is a risk profile. That's really important because investments will experience volatility or negative returns over the long term. So you need to have a candid conversation with yourself and really know that if you can stomach the market going up and down, maybe you're an anxious person, maybe you can't. And the higher returns that an investment seeks to provide, the higher potential volatility or negative returns there are. Investment horizon is the length of time that it is recommended you invest for. So this will be outlined within the PDS and the TMD. It's generally recommended that the higher the risk, the longer investment horizons, because in certain years, potentially you will experience negative returns and you will need to be invested in that fund for longer to recoup those losses. And that's really important to consider when you're looking at investing. And just finally, I wanted to highlight the difference between risk and volatility. So a higher return implies a higher risk and vice versa. However, risk is not the same as volatility. So volatility is how often the price of an asset goes up and down in the short term. And this can be determined by a lot of things. It can be determined by macroeconomic trends. It can be impacted by buyers going in and out of the market. And generally, it is separate from risk as it doesn't pertain typically to the underlying fund manager's investments. And you can see here, this is an example of volatility. You can see there's this dip and it goes up, and then there's a dip and then it goes up and then up and it stops. And you can see like that, and it's quite a volatile asset. But that volatility was only at a point in time, and it actually just happened to be the COVID dip, as people call it. And nearly every investment experienced that sort of volatility. But you can see that over the long term, as you have that longer investment horizon, you'll be able to weather those negative periods of returns. And so that's really important for you to consider as you start your investing journey, is the investment will go up and down in the short term, but over the long term, generally, the investments will go up, as you can see here. And this is the Morningstar high growth. Okay, so that was a crash course on investing. Now we're getting to the goals-based financial planning. There's 4 parts to this. Knowing how much your goal costs, when do you want to achieve your goal, how much have you saved, and how much can you save? And it's really important to think of goals. We often come across people or clients that say, oh, my goal is just to have $1 million in retirement. And generally for a lot of people, that doesn't mean anything. It's just a number they picked. Maybe the goal is just to be rich, which is even worse because there's not even a number attached to it. That's not goals. That's just simply maximizing your wealth. And the reason that's bad is because, unless $1 million meant something to you personally, there's no personal attachment to that. Whereas goals is saving for a house, it's maybe going for a holiday, it's retiring with dignity, it's maybe having a dog, maybe having kids. And so as you go through this process of mapping out your goals, it's important to think about what you really want and be quite pragmatic about it, because it will be quite a cold reality that you will have to make trade-offs. And when I studied economics, we typically talked about agents having unlimited wants, but there's scarcity. And it seemed quite contrived when I was studying it in uni, but it's true for really most people. You can't have all that you want, and you have to make sacrifices and trade-offs. I would love Ferrari 250 GT California, but I've had to settle for a 1980s BMW instead. So those are the sort of things that you have to consider throughout this process. So I'm going to take you through that process of goals-based financial planning now. You're going to want to define your goal. In this example, I've picked retirement because it's quite tangible for a lot of people. Everyone will retire at some point. In actuality, everyone's goals are unique besides that. But for the sake of demonstration, you can simply put in whatever goals that you want. So going back to that example that I showed you right at the start, if you would recall those modeling scenarios where I showed that investment curve, I'm going to take that and I'm going to go in 40 years, and I'm assuming I'm 25. I want to retire when I'm 65. So that's the goal. The second part of step one is to get a value for that goal. Now, I've simply taken a industry published value. This is something that the government refers to, insurers refer to, super funds refer to. It's a lifestyle standard that's published each year. And I've simply taken having a comfortable lifestyle. A comfortable lifestyle in retirement is pretty generous. It's doing things like going on a couple of holidays every year, your house is paid off. And I think it's something great that we could aspire to, even though at face value, $50,000 isn't a lot. So I've taken $50,000 is the value of the goal, and I want to achieve that in 40 years. I've made an assumption that there will be 2.5% inflation every year for the next 40 years. And that means that by the time I'm 65, I will need to have enough saved up such that my income, based on my investment or my savings, will have to be $134,000 in that day's dollars in 40 years. And you can use a simple inflation calculator. The Reserve Bank has one. Money Smart has one. It's an easy Google search. Then what I'm going to do, given it's retirement, is I'm using a 4% withdrawal rate. That is the legislated minimum. And 4%, what I've done is I've divided 134,000. I've divided it by 0.04. And that'd give me the total portfolio's value that I would need, such that if I drew down 4% every year, I would get this amount. So in 40 years' time, I need just over $3.3 million if I want to retire in today's money with $50,000 every year. And so this is what it looks like. That's my goal there. And that's it with how investing. So step two is you will need to understand what your contributions are, what sort of rate of return is required, and what the future value of that is going to be. Now, I'm not going to go into these following slides in too much depth, but what I've done is I've recreated one of Morningstar's tools that you would otherwise have to pay for into some formulas in Excel. So anyone can do this, and I'm sure when Nina and Janita send the post follow-up comms, they can pop this in there. But this is a simple calculator. If you follow the steps, what I've done is I've mapped out from year 1 to 40 these contributions that I hypothetically make from that scenario right back at the start of the presentation. I've assumed this rate of return here, and this is accumulated value over that 40-year investment horizon. So I've gone through here and put notes on how to do this, but I'll let you refer to that in your own time. So you've worked out how much you need, how much you contribute. You've worked out what the rate of return is. Then you need to pick your asset allocation. So, for example, in a lot of funds, they simply just denote this as growth, high growth, moderate, balanced, conservative. Morningstar uses terms like aggressive, and that is simply describing the asset allocation. It's investing in higher risk, higher return assets with the intention to make more money for you based on the investment objective. So once you've worked out your goal, how much it'll be, how much you need to save, what returns you need, and then you've picked the investment, you then need to select those investments. What you'll start to do now is you'll start to put together a plan. So what will you invest in? Whether it be super, whether it's shares, whether it's ETFs, how often will you invest? Monthly, quarterly, annually? And how often will you review your portfolio? And this is really important as well for a lot of people. I hear that are quite anxious, or they get quite worried when they see their returns dip. Morningstar typically recommends that you check it quarter, twice a year, or once a year. And a famous behavioral economist, Richard Thaler, did a study on this, and it was quite interesting. What he found was, out of two sets of participants, there's one that checked their portfolio at the start of a 12-month period and at the end. And then you got a second group of participants, and then they check the portfolio every day, 365 days a year. And simply by checking your portfolio every single day, he referred to it as if you're going up to and giving yourself and tempting yourself the opportunity to buy or sell every day. And what he found was that the returns of those that check their investments every day were significantly lower, because it just gives you that temptation to see that you've lost money and to sell when you shouldn't sell. So going back to my goal and looking at what we've done, if you would recall, right at the start of the presentation, I assumed 7% returns. I was investing $120 a week. My goal was just over 3.3 million, and I needed to do it in 40 years. Now, for me to get there, I would need a return of 10.8%, which for reference is very, very high. Maybe even unrealistic. I'm not sure. So you've gone through the 4 steps and you get to this point, and this is a chance for you to reflect. And this is where the power of goals-based financial planning comes in. And you start to make those trade-offs and really question your goals, your savings. And it's at this point you can piece it together and bring in the budgeting. You can bring in those foundational work that you've done and the plan to make this work. So what do you do? Well, in 40 years, it's 10.8% is pretty unrealistic. Maybe I have to delay retirement. I can invest more aggressively, but probably not. I can increase savings, and $120 a week is, I could probably do more there, or I reduce my goal. And so this gives you that framework where you start to make those hard decisions and make those trade-offs, which once you have that framework in place, gives you that peace of mind that you have committed towards something. I wanted to put this in another perspective. In that example, I assumed 7%, and what I really needed was 10.8%. But what if we went the other way? Instead of a 7% return assumption, imagine it was 4% instead. What's the difference over a 40-year period? And the reason I'm highlighting it the other way is because a lot of people within their superannuation account are often invested in what's called a My Super account. And that tends to be quite low risk, low return. It's generally what the industry would call balanced portfolios, typically for most funds, and they will have a lower return. So let's assume that that was 4%. And it's quite a significant difference. So from that earlier example, from the start of the presentation, I had just over 1.3 mil. If I was investing $120 every week for 7% return year on year, well, at 4%, I'm only just over 500,000. So you've done the foundation work. You've worked through the 4-step financial planning goal-based framework. You've got the plan. Where to now? The number one step that we would recommend is reviewing your super fund. Firstly, review the fund's overall fees and features. So you need to review, just to recap, not just the investment options fees, but also the fund's fees, so the administration, insurance, the other features. Look at the fund profile that you're invested in. Obviously noting that for nearly every Australian, life insurance, TPD, disability, that sort of insurance is all wrapped up within superannuation. So if you are looking to change your fund, keep that in mind because that could have implications. The second is opening a brokerage account and beginning investing. And with that, that rounds out the presentation. The only other thing I'd suggest is my colleagues, Mark and Shani here, they have a fantastic podcast on Spotify. It's called Investing Compass, and they talk a lot about these topics. So with that, I think, Janita, we could probably answer any questions.
Wonderful. Thank you so much, Tom. What a great presentation. So much information for us all to take in. Now, we do have some questions here that have come through. So first off, let's start with this question from Anonymous. How do you handle your emotion when you are in loss? And how do you manage your emotion to make sure that it does not affect you?
Yep. Yeah, that's a good question. I would refer back to what I said when you're putting together an investment plan. Really, the simplest thing is just to not look at it. It's as simple as that. Now, if you find that when you're looking at it and you can't handle seeing that volatility or uncertainty, that would suggest to me that your tolerance for risk is probably quite low, even in spite of you taking on higher risk to make more money for that goal. So you need to go away and you need to assess, well, can I really tolerate this sort of risk for the next 40 years? Is earning an extra 100,000, 200,000, 300,000 worth it if every week I'm looking at my investments and causing stress? And that's where you need to review your goals.
Fantastic. Thank you. And just going along the list here, how should you plan how to split up your paychecks? Yeah,
that's a good question. So obviously when you're starting out, you would be building up that emergency fund. I personally, I simply just allocate towards expenses first. I give myself a bit of pocket money to play with, and then the rest just goes to savings. It really depends on your lifestyle. And I think when you do the budgeting within that, that'll give you a sense of, what you have to pay. You have to pay rent, you have to pay for food, and that should obviously be prioritized. But be realistic with yourself. Going back to that avo and toast anecdote, it isn't realistic for you to cut that out. When you do have a financial plan, you can't go very austere. You have to live. I use avo on toast because I love food, and I still give myself the flexibility. Probably when I was going out 3 nights a week, that was a bit much. But if you give yourself flexibility to go out, one morning a week for breakfast, that's a good thing. The only other thing I would suggest is I spoke about Richard Thaler. He had another study called Save More Tomorrow. What he showed was that those that are expecting a pay rise soon, and that's very pertinent for us as recent graduates, it's a significant jump from working, part-time at the pub, is once you get that paycheck, to go to HR and tell them just to put an amount in a separate account that you'll never see. And so you'll never get used to having your full salary. And what he found is that taking away that money before you even got used to spending it or got used to living on that salary meant your investment outcomes were a lot better because you removed that temptation.
I really like that. I love that advice. Got a few anonymous questions coming through here. Don't be shy, everyone. But we do have one here from Omafomun. Where do you advise I invest the 10% of my weekly income? I think you have touched on this in a few points of your presentation, but just a little bit of a recap for this question.
Yeah, I couldn't give you any specific advice. Really what it comes down to is doing that plan and working through your goals first. It's taking the approach of not where should I invest, it's how much do I need based on my goals, what returns do I need to get there, and how much risk and savings am I prepared to make over that period. And that'll take a lot of the decision making out of it.
Right. Now, just looking at some of these questions here as well. How, Anonymous has asked as well, how do I find a point to build my financial security?
Yeah, that's a good question. The point is now. It's today. And in all seriousness, it's if you don't have that emergency fund, it would be starting there. Because knowing that you have those expenses taken care of for that period means you can take those risks and just start investing because it is risk. And that'll mentally take that load off you that if you start investing or start saving for a house deposit, if you lose your job or life gets in the way, that you've got that money there to take care of you. So I would be starting with that emergency fund first and foremost.
Wonderful. Thank you, Tom. We have a question here from Liam Hennessy. He asked, how would you approach the information overload aspect, especially when first starting out? It's like people want to do it all, but that overwhelming fear of the unknown probably stops decision-making and action.
Yeah, that's a good question, Liam. With having a plan like this, funnily enough, the thing that it does is mentally, by committing to it, it frees you up of that load. So I refer to the previous question. Don't look at it so much as having to analyze investments or what do I pick, ETF or shares, or think of it more so in having a frank conversation with what sort of life you want to live. How much is that going to cost? How long are you prepared to wait for it? Because the longer that you can delay that gratification, the greater those returns that you would have over time. And making that decision from a lifestyle perspective first, how much it'll cost going through the plan, that'll really, I think, take that mental load off you. And I think as well, just having fun with it. I'm a hobby, but I work in financial services, but it can be fun.
Yeah. We've had a couple of questions come through here in regards to books and what books you recommend reading. Hayden and Lachlan have both inquired about, do you have your top sort of 3 finance books that you recommend that aren't textbooks?
I thought I was going to get this question, so I dusted off my library. Number 1, I don't know if you can't see
that one.
This is called Thinking Fast and Slow by Daniel Kahneman. Now, this is not a finance book, although we did study this in my behavioral economics course in 3rd year. Daniel Kahneman is one of the world's leading behavioral scientists, and he was sort of the forefather of this field. This is a fantastic book, and maybe it goes back to, I think it was Liam's question about information overload and where to start. Daniel talks about the different, the different brains that we have, and it talks about how you can process how we've evolved to be as beings and the coping mechanisms and heuristics and biases that we have. And it's really interesting research. If you are a bit more into the finance as hobby, this one here, it's called Intelligent Investor. It's a bit chunky. this was in essence the book that Warren Buffett sort of got into investing on. So that's by Benjamin Graham, and he takes more of a stock-based focus. So if you're really interested in stock investing or shares, he'll go through how to analyze a company and invest. So that's, yeah, if you're a bit more into the investing, I'd recommend that.
Definitely. Thank you so much for that, Tom. And we'll definitely get those titles from you as well that we can share with the attendees afterwards if they didn't quite get that from the video. Maria asks, would having HEX debt influence your investing decisions? And would there be situations where paying off HEX debt more quickly is a better way to spend rather than investing the money?
I really don't know. I mean, it depends on your situation. You know, I was someone that sort of jumped around a bit, swapped degrees, so I've got probably quite a high HEX debt for what I actually got out of uni. So, like in my situation, yes. Probably a few years ago when interest rates were low, no, because it's the cheapest debt that you could have. But now that interest rates and costs of living are increasing, I know I certainly got slogged with a pretty high indexation with the HEX. So it really just depends on what you value, the balance of your HEX account is, versus what sort of returns that you're trying to achieve. So if you've done the goal-based framework, and if your returns that you need are higher than the HEX debt, I'd always suggest investing. But if the HEX debt interest rate is higher, pay that off first.
Thanks, Tom. Now, just to wrap everything up, we are running out of time, but just as one of our last questions, what are some investment tools you would recommend?
Good question. I got to plug the team. Morningstar Investor. Now, it's probably not suitable for a lot of people here. It's quite expensive, but frequently they run free access, and frequently they will do student pricing. So if there's any students here, I'd check that out. I obviously showed the calculator on how to build that, Money Smart. And then finally, another industry peer that we work quite closely with is called ShareSite. ShareSite is a fantastic tool. They've got a free access, and I think the most expensive subscription is maybe $30 a month. So if you really want to get into like building portfolios and like understanding the market, I would highly suggest ShareSite as well as Morningstar Investor. And we sort of integrate with the two platforms as well. So yeah, besides the ones that I've spoken about, Morningstar Investor and ShareSite would be great.
Okay. Thank you so much, Tom. And to everyone who has submitted questions that we haven't gotten to, really sorry that we have run out of time, but we will review those questions and send them through to Tom as well. And if there are any that we can provide a small recap on or be able to answer, we'll put that into a post-event email out to everyone. I would like to just draw an official close to the webinar, and I would like to send a really heartfelt thank you to Tom for your valuable insights, and to all of you for participating so actively in today's webinar. For those of you who wish to revisit any part of today's presentation or share it with others, a recording will be made available and shared with all registrants. So we do believe in the power of knowledge sharing and continuous learning, so please look out for that in your inboxes. We also encourage you to stay connected with the UQ Young Alumni Advisory Board as well through the UQ Changemakers app. This is a fantastic way to keep in the loop of upcoming events, valuable resources and networking opportunities tailored specifically for our young alumni community. Looking ahead, we are thrilled about what's in store for 2024, and we are eager to share our program with you soon. It promises to be filled with even more engaging and enriching experiences, and will help you empower to continue making strides in your professional and personal development as well. So really looking forward to being able to share our program for next year. But thank you once again for joining us. Your engagement today sort of speaks volumes of your commitment to your financial well-being and professional growth. So kudos to everyone who joined today. Definitely keep an eye out on the UQ Changemakers app. And until next time, please stay connected and keep forging your path to financial security. So goodbye for now, and really looking forward to welcoming you to future events.